Much of the financial damage befell pension funds for public employees. Many of these funds are woefully underfunded, in part because they have suffered a double whammy: poor investment performance accompanied by huge fees. The resulting shortfalls in their assets will for decades have to be made up by local taxpayers. Human behavior won't change. Wealthy individuals, pension funds, endowments, and the like will continue to feel they deserve something extra in investment advice. Those advisors who cleverly play to this expectation will get very rich. This year the magic potion may be hedge funds, next year something else. The likely result from this parade of promises is predicted in an adage. When a person with money meets a person with experience, the one with experience ends up with the money, and the one with money leaves with experience. Long ago, a brother-in-law of mine, Homer Rogers, was a commission agent working in the Omaha stockyards. I asked him how he induced a farmer rancher to hire him to handle the sale of their hogs or cattle to the buyers from the big four packers: Swift, Cudahy, Wilson, and Armour. After all, hogs were hogs and the buyers were experts who knew to the penny how much any animal was worth. How then, I asked Homer, could any sales agent get a better result than any other? Homer gave me a pitying look and said, "Warren, it's not how you sell 'em, it's how you tell 'em." What worked in the stockyards continues to work in Wall Street. And finally, let me offer an olive branch to Wall Streeters, many of them good friends of mine. Berkshire loves to pay fees, even outrageous fees, to investment bankers who bring us acquisitions. Moreover, we have paid substantial sums for overperformance to our 2 in-house investment managers, and we hope to make even larger payments to them in the future. To get biblical, Ephesians 3:18. I know the height and the depth and the length and the breadth of the energy flowing from that simple 4-letter word fees when it is spoken to Wall Street. And when that energy delivers value to Berkshire, I will cheerfully write a big check. The annual meeting. Last year we partnered with Yahoo to air the first ever webcast of our annual meeting. Thanks to Andy Serwer and his Yahoo crew, the production was a success in all respects, registering 1.1 million unique visits in real-time viewing and 11.5 million more in replays. Many of those, to be sure, called up by viewers interested in only certain segments of the webcast. Berkshire's thank you mail for initiating the webcast included many notes from 3 constituencies: the elderly who find travel difficult, the thrifty who find it expensive to travel to Omaha, and those who cannot attend a Saturday meeting for religious reasons. The webcast cut attendance at last year's meeting to about 37,000 people. We can't get a precise count, which was down about 10%. Nevertheless, both Berkshire's subsidiaries and Omaha hotels and restaurants racked up huge sales. Nebraska Furniture Mart's sales broke their 2015 record volume by 3%, with the Omaha store recording 1-week volume of $45.5 million. Our Berkshire exhibitors at CenturyLink were open from noon until 5 p.m. on Friday and drew a crowd of 12,000 bargain-hunting shareholders. We will repeat those Friday shopping hours this year, on May 5th. Bring money. The annual meeting falls on May 6th and will again be webcast by Yahoo, whose web address is https://finance.yahoo.com, livestream. The webcast will go live at 9 a.m. Central Daylight Time. Yahoo will interview directors, managers, stockholders, and celebrities before the meeting and during the lunch break. Both those interviews and meeting will be translated simultaneously into Mandarin. For those attending the meeting in person, the doors at the CenturyLink will open at 7 a.m. on Saturday to facilitate shopping prior to our shareholder movie, which begins at 8:30. The question and answer period will start at 9:30 and run until 3:30, with a 1-hour lunch break at noon. Finally, at 3:45, we will begin the formal shareholder meeting. It will run an hour or so. That is somewhat longer than usual because 3 proxy items are to be presented by their proponents, who will be given a reasonable amount of time to state their case. On Saturday morning, we will have our 6th International Newspaper Tossing Challenge. Our target will again be the porch of a Clayton home, located precisely 35 feet from the throwing line. When I was a teenager in my one brief flirtation with honest labor, I delivered about 500,000 papers. So I think I'm pretty good at this game. Challenge me, humiliate team, knock me down a peg. The papers will run 36 to 42 pages, and you must fold them yourself, no rubber bands allowed. The competition will begin about 7:45, and I'll take on 10 or so competitors selected a few minutes earlier by my assistant, Deb Bosanek. Your venue for shopping will be the 194,300 square foot hall that adjoins the meeting, and in which products from dozens of our subsidiaries will be for sale. Say hello to the many Berkshire managers who will be captaining their exhibits. And be sure to view the terrific BNSF railroad layout that salutes all of our companies. Your children, and you, will be enchanted with it. Brooks, our running shoe company, will again have a special commemorative shoe to offer at the meeting. After you purchase a pair, wear them on Sunday at our 4th annual Berkshire 5K, an 8 a.m. race starting at the CenturyLink. Full details for participating will be included in the visitor's guide that will be sent to you with your meeting credentials. Entrants in the race will find themselves running alongside many of Berkshire's managers, directors, and associates. Charlie and I, however, will sleep in. The fudge and peanut brittle we eat throughout the Saturday meeting takes its toll. Participation in the 5K grows every year. Help us set another record. A Geico booth in the shopping area will be staffed by a number of the company's top counselors from around the country. At last year's meeting, we set a record for policy sales, up 21% from 2015. I predict we will be up again this year. So stop by for a quote. In most cases, Geico will be able to give you a shareholder discount, usually 8%. This special offer is permitted by 44 of the 51 jurisdictions in which we operate. One supplemental point. The discount is not additive if you qualify for another discount, such as that available to certain groups. Bring the details of your existing insurance and check out our price. We can save many of you real money. Spend the savings in other Berkshire products. Be sure to visit the Bookworm. This Omaha-based retailer will carry about 3-5 books and DVDs, among them a couple of new titles. The best book I read last year was Shoe Dog, by Nike's Phil Knight. Phil is a very wise, intelligent, and competitive fellow, who is also a gifted storyteller. The Bookworm will have piles of Shoe Dog as well as several investment classics by Jack Bogle. The Bookworm will once again offer our history of the highlights and lowlights of Berkshire's first 50 years. Non-attendees of the meeting can find the book on eBay. Just type in Berkshire Hathaway, Incorporated celebrating 50 years of a profitable partnership, 2nd edition. An attachment to the proxy material that is enclosed with this report explains show you can obtain the credential you will need for admission to both the meeting and other events. Keep in mind that airlines have sometimes jacked up prices for the Berkshire weekend, though, I must admit, I have developed some tolerance, bordering on enthusiasm, for that practice now that Berkshire has made large investments in America's 4 major carriers. Nevertheless, if you are coming from far away, compare the cost of flying to Kansas City versus Omaha. The drive between the two cities is about 2.5 hours, and it may be that Kansas City can save you significant money. The savings for a couple could run to $1,000 or more. Spend that money with us. At Nebraska Furniture Mart, located on a 77-acre site on 72nd Street between Dodge and Pacific, we will again be having Berkshire Weekend discount pricing. To obtain the Berkshire discount at NFM, you must make your purchases between Tuesday, May 2nd and Monday, May 8th inclusive, and must also present your meeting credential. The period special pricing will even apply to the products of several prestigious manufacturers that normally have ironclad rules against discounting, but which, in the spirit of our shareholder weekend, have made an exception for you. We appreciate their cooperation. During Berkshire Weekend, NFM will be open from 10 a.m. to 9 p.m. Monday through Friday, 10 a.m. to 9:30 p.m. on Saturday and 10 a.m. to 8 p.m. on Sunday. From 5:30 p.m. to 8 p.m. on Saturday, NFM is hosting a picnic to which you are all invited. This year we have good news for shareholders in the Kansas City and Dallas metro markets who can't attend the meeting or perhaps prefer the webcast. From May 2nd through May 8th, shareholders who present meeting credentials or other evidence of their Berkshire ownership, such as brokerage statements, to their local NFM store will receive the same discounts enjoyed by those visiting the Omaha store. At Borsheim's, we will again have 2 shareholder-only events. The first will be a cocktail reception from 6 p.m. to 9 p.m. on Friday, May 5th. The second, the main gala, will be held on Sunday, May 7th, from 9 a.m. to 4 p.m. On Saturday, we will remain open until 6 p.m. Remember, the more you buy, the more you save. Or so my daughter tells me when we visit the store. We will have huge crowds at Borsheim's throughout the weekend. For your convenience, therefore, shareholder prices will be available from Monday, May 1st through Saturday, May 13th. During that period, please identify yourself as a shareholder, either by presenting your meeting credential or a brokerage statement showing you own our stock. On Sunday, in the mall outside of Borsheim's, Norman Beck, a remarkable magician and motivational speaker from Dallas, will bewilder onlookers. On the upper level, we will have Bob Hammond and Sharon Osberg, two of the world's top bridge experts, available to play with our shareholders on Sunday afternoon. If they suggest wagering on the game, change the subject. I will join them at some point, and hope Ajit, Charlie and Bill Gates will do so also. My friend Ariel Singh will be in the mall as well on Sunday, taking on challengers at table tennis. I met Ariel when she was 9, and even then I was unable to score a point against her. Ariel represented the United States in the 2012 Olympics. Now, she's a senior at Princeton, after interning last summer at JP Chase. If you don't mind embarrassing yourself, test your skills against her, beginning at 1 p.m. Bill Gates did pretty well playing Ariel last year, so he may be ready to again challenge her. My advice: bet on Ariel. Gorats will be open exclusively for Berkshire shareholders on Sunday, May 7th, serving from 1 p.m. until 10 p.m. To make a reservation at Gorats, call 402-551-3733 on April 3rd, but not before. Show you are a sophisticated diner by ordering the T-bone with hash browns. We will have the same 3 financial journalists lead the question and answer period at the meeting, asking Charlie and me questions that shareholders have submitted to them by email. The journalists and their email addresses are Carol Loomis, the preeminent business journalist of her time, who may be emailed at loomisburke@gmail.com, Becky Quick, of CNBC, at berkshirequestions@cnbc.com, and Andrew Ross Sorkin, of the New York Times, at rsorkin@nytimes.com. From the questions submitted, each journalist will choose the 6 he or she decides are the most interesting and important to shareholders. The journalists have told me your question has the best chance of being selected if you keep it concise, avoid sending it in at the last moment, make it Berkshire-related and include no more than 2 questions in any email you send them. In your email, let the journalists know if you would like your name mentioned if your question is asked. An accompanying set of questions will be asked by 3 analysts who follow Berkshire. This year the insurance specialist will be Jay Gelb of Barclays. Questions that deal with our non-insurance operations will come from Jonathan Brandt of Ruane, Cunniff and Goldfarb and Greg Warren of Morningstar. Since what we will be conducting is a shareholders meeting, our hope is that the analysts and journalists will ask questions that add to our owners' understanding and knowledge of their investment. Neither Charlie nor I will get so much as a clue about the questions headed our way. Some will be tough, for sure, and that's the way we like it. Multi-part questions aren't allowed. We want to give as many questioners as possible a shot at us. Our goal is for you to leave the meeting knowing more about Berkshire than when you came, and for you to have a good time while in Omaha. All told, we expect at least 54 questions, which will allow for 6 from each analyst and journalist, and for 18 from the audience. The questioners from the audience will be chosen by means of 11 drawings that will take place at 8:15 a.m. on the morning of the annual meeting. Each of the 11 microphones installed in the arena and main overflow room will host, so to speak, a drawing. While I'm on the subject of our owners gaining knowledge, let me remind you that Charlie and I believe all shareholders should simultaneously have access to new information that Berkshire releases, and, if possible, should also have adequate time to digest and analyze it before any trading takes place. That's why we try to issue financial data late on Fridays or early on Saturdays, and why our annual meeting is always held on a Saturday, a day that also eases traffic and parking problems. We do not follow the common practice of talking one-on-one with large institutional investors or analysts, treating them instead as we do all other shareholders. There is no one more important to us than the shareholder off-limited means who trusts us with a substantial portion of his or her savings. As I run the company day to day, and as I write this letter that is the shareholder whose image is in my mind, for good reason, I regularly extol the accomplishments of our operating managers. They are truly all-stars who run their businesses as if they were the only asset owned by their families. I also believe the mindset of our managers to be as shareholder-oriented as can be found in the universe of large publicly owned companies. Most of our managers have no financial need to work. The joy of hitting business home runs means as much to them as their paycheck. Equally important, however, are the men and women who work with me at our corporate office. This team efficiently deals with a multitude of SEC and other regulatory requirements, files a 30,450-page federal income tax return, oversees the filing of 3,580 state tax returns, responds to countless shareholder and media inquiries, gets out the annual report, prepares for the country's largest annual meeting, coordinates the board's activities, fact-checks this letter, and the list goes on and on. They handle all of these business tasks cheerfully and with unbelievable efficiency, making my life easy and pleasant. Their efforts go beyond activities strictly related to Berkshire. Last year, for example, they dealt with the 40 universities, selected from 200 applicants, who sent students to Omaha for a Q&A day with me. They also handle all kinds of requests that I receive, arrange my travel, and even get me hamburgers and French fries, smothered in Heinz ketchup, of course, for lunch. In addition, they cheerfully pitch in to help Carrie Sova, our talented ringmaster at the annual meeting, deliver an interesting and entertaining weekend for our shareholders. They are proud to work for Berkshire, and I am proud of them. I'm a lucky guy, very fortunate in being surrounded by this excellent staff, a team of highly talented operating managers and a boardroom of very wise and experienced directors. Come to Omaha, the cradle of capitalism, on May 6th, and meet the Berkshire Bunch. All of us look forward to seeing you. The 25th of February 2017, Warren E. Buffett, Chairman of the Board. 1951. The security I like best. Geico. Referred to in the 2005 letter to shareholders. Reprinted from the Commercial and Financial Chronicle. Thursday, the 6th of December, 1951. The security I like best. Warren E. Buffett, Buffett Falk, Co., Omaha, Newbury. Government Employees Insurance Co. Full employment, boom-time profits and record dividend payments do not set the stage for depressed security prices. Most industries have been riding this wave of prosperity during the past 5 years with few ripples to disturb the tide. The auto insurance business has not shared in the boom. After the staggering losses of the immediate post-war period, the situation began to right itself in 1949. In 1950, stock casualty companies again took it on the chin, with underwriting experience the second worst in 15 years. The recent earnings report of casualty companies, particularly those with the bulk off-writings in auto lines, have diverted bull market enthusiasm from their stocks. On the basis of normal earning power and asset factors, many of these stocks appear undervalued. The nature of the industry is such as to ease cyclical bumps. Auto insurance is regarded as a necessity by the majority of purchasers. Contracts must be renewed yearly at rates based upon experience. The lag of rates behind costs, although detrimental in a period of rising prices, as has characterized the 1945 to 1951 period, should prove beneficial if deflationary forces should be set in action. Other industry advantages include lack of inventory, collection, labor and raw material problems. The hazard of product obsolescence and related equipment obsolescence is also absent. Government Employees Insurance Corporation was organized in the mid-30s to provide complete auto insurance on a nationwide basis to an eligible class, including 1. Federal, state, and municipal government employees, 2. Active and reserve commissioned officers, and the first 3 pay grades of non-commissioned officers of the armed forces, 3. Veterans who were eligible when on active duty, 4. Former policyholders, 5. Faculty members of universities, colleges, and schools. 6. Government contractor employees engaged in defense work exclusively. And 7. Stockholders. The company has no agents or branch offices. As a result, policyholders receive standard auto insurance policies at premium discounts running as high as 30% off manual rates. Claims are handled promptly through approximately 500 representatives throughout the country. The term growth company has been applied with abandon during the past few years to companies whose sales increases represented little more than inflation of prices and general easing of business competition. Geico qualifies as a legitimate growth company based upon the following record. Of course, the investor of today does not profit from yesterday's growth. In Geico's case, there is reason to believe the major portion of growth lies ahead. Prior to 1950, the company was only licensed in 15 of 50 jurisdictions including D.C. and Hawaii. At the beginning of the year, there were less than 3,000 policyholders in New York State. Yet 25% saved on an insurance bill of $125 in New York should look bigger to the prospect than the 25% saved on the $50 rate in more sparsely settled regions. As cost competition increases in importance during times of recession, Geico's rate attraction should become even more effective in diverting business from the brother-in-law. With insurance rates moving higher due to inflation, the 25% spread in rates becomes wider in terms of dollars and cents. There is no pressure from agents to accept questionable applicants or renew poor risks. In states where the rate structure is inadequate, new promotion may be halted. Probably the biggest attraction of Geico is the profit margin advantage it enjoys. The ratio of underwriting profit to premiums earned in 1949 was 27.5% for Geico as compared to 6.7% for the 135 stock casualty and surety companies, summarized by Best's. As experience turned for the worse in 1950, Best's aggregate's profit margin dropped to 3% and Geico's dropped to 18%. Geico does not write all casualty lines. However, bodily injury and property damage, both important lines for Geico, were among the least profitable lines. Geico also does a large amount of collision writing, which was a profitable line in 1950. During the first half of 1951, practically all insurers operated in the red on casualty lines, with bodily injury and property damage among the most unprofitable. Whereas Geico's profit margin was cut to slightly above 9%, Massachusetts's bonding and insurance showed a 16% loss, New Amsterdam casualty an 8% loss, standard accident insurance a 9% loss, etc. Because of the rapid growth of Geico, cash dividends have had to remain low. Stock dividends and a 2-5-for-1 split increased the outstanding shares from 3,000 on the 1st of June 1948 to 250,000 on the 10th of November 1951. Valuable rights to subscribe to stock of affiliated companies have also been issued. Benjamin Graham has been chairman of the board since his investment trust acquired and distributed a large block of the stock in 1948. Leo Goodwin, who has guided Geico's growth since inception, is the able president. At the end of 1950, the 10 members of the board of directors owned approximately 1/03 of the outstanding stock. Earnings in 10 equals 950 amounted to $3.92, as contrasted to $4.71 on the smaller amount of business in 1949. These figures include no allowance for the increase in the unearned premium reserve, which was substantial in both years. Earnings in 1951 will be lower than 1950, reflecting the growth of the company's assets. At the present price of about 8 times the earnings of 1950, a poor year for the industry, it appears that no price is being paid for the tremendous growth potential of the company. This is part of a continuous forum appearing in the Chronicle, in which each week, a different group of experts in the investment and advisory field from all sections of the country participate and give their reasons for favoring a particular security. 1953. The security I like best, Western Insurance, the security I like best. A continuous forum in which, each week, a different group of experts in the investment and advisory field from all sections of the country participate and give their reasons for favoring a particular security. March 1953. Warren E. Buffett, Buffett Falcon Co., Omaha, Niebuhr. Western Insurance Securities Common Stock. Again, my favorite security is the equity stock of a young, rapidly growing and ably managed insurance company. Although Government Employees Insurance Co., my selection of 15 months ago, has had a price rise of more than 100%, it still appears very attractive as a vehicle for long-term capital growth. Rarely is an investor offered the opportunity to participate in the growth of 2 excellently managed and expanding insurance companies on the grossly undervalued basis, which appears possible in the case of the Western Insurance Securities Company. The 2 operating subsidiaries, Western Casualty and Surety and Western Fire, wrote a premium volume of $26,009,929 inches, 1,952, on consolidated admitted assets of $29,590,142. Now licensed in 38 states, their impressive growth record, both absolutely and relative to the industry, is summarized in Table 1 below. Western Insurance Securities owns 92% of Western Casualty and Surety, which in turn owns 99.95% of Western Fire Insurance. Other assets of Western Insurance Securities are minor, consisting of approximately $180,000 inches net quick assets. The capitalization consists of 7,000 shares of $100 par 6% preferred, callable at $125. 35,000 shares of Class A, preferred, callable at $60, which is entitled to a $2.50 regular dividend and participates further up to a maximum total of $4 per share, and 50,000 shares of common stock. The arrears on the Class A presently amount to $36.75. The management headed by Ray Duboc is of the highest grade. Mr. Duboc has ably steered the company since its inception in 1924, and has a reputation in the insurance industry of being a man of outstanding integrity and ability. The second tier of executives is also of top caliber. During the formative years of the company, senior charges were out of line with the earning power of the enterprise. The reader can clearly perceive why the same senior charges that caused such great difficulty when premium volume ranged about the $3 million mark would cause little trouble upon the attainment of premium volume in excess of $26 million. Adjusting for only 25% of the increase in the unearned premium reserve, earnings of $1,367,063 in 1952, a very depressed year for auto insurers, were sufficient to cover total senior charges of $129.500 more than 10 times over, leaving earnings of $24.74 on each share of common stock. It is quite evident that the common stock has finally arrived, although investors do not appear to realize it since the stock is quoted at less than twice earnings and at a discount of approximately 55% from the December 31, 1952 book value of $86.26 per share. Table 2 indicates the post-war record of earnings and dramatically illustrates the benefits being realized by the common stock because of the expanded earnings base. The book value is calculated with allowance for a 25% equity in the unearned premium reserve and is after allowance for call price plus arrears on the preferreds. Since Western has achieved such an excellent record in increasing its industry share of premium volume, the reader may well wonder whether standards have been compromised. This is definitely not the case. During the past 10 years, Western's operating ratios have proved quite superior to the average multiple line company. The combined loss and expense ratios for the two Western companies as reported by the Alfred M. Best Co. on a case basis are compared in Table 3 with similar ratios for all stock fire and casualty companies. The careful reader will not overlook the possibility that Western's superior performance has been due to a concentration of writings in unusual profitable lines. Actually, the reverse is true. Although represented in all major lines, Western is still primarily an automobile insurer with 60% of its volume derived from auto lines. Since automobile underwriting has proven generally unsatisfactory in the post-war period, and particularly so in the last 3 years, Western's experience was even more favorable relative to the industry than the tabular comparison would indicate. Western has always maintained ample loss reserves on unsettled claims. Underwriting results in the post-war period have shown Western to be over-reserved at the end of each year. Triennial examinations conducted by the insurance commissioners have confirmed these findings. Turning to their investment picture, we of course find a growth in invested assets and investment income paralleling the growth in premium volume. Consolidated net assets have risen from $5,154,367 in 1940 to their present level of $29,590,142. Western follows an extremely conservative investment policy, relying upon growth in premium volume for expansion in investment income. Of the year-end portfolio of $21,889,243, governments plus a list of well-diversified high-quality municipals total $141,246 or 92%, and stocks only $1,747,997 or 8%. Net investment income of $474,472 in 1952 was equal to $6.14 per share of Western Insurance, common after minority interest and assuming senior charges were covered entirely from investment income. The casualty insurance industry during the past several years has suffered staggering losses on automobile insurance lines. This trend was sharply reversed during late 1952. Substantial rate increases in 1951 and 1952 are being brought to bear on underwriting results. With increasing force, as policies are renewed at much higher premiums. Earnings within the casualty industry are expected to be on a very satisfactory basis in 1953 and 1954. Western, while operating very profitably during the entire trying period, may be expected to report increased earnings as a result of expanding premium volume, increased assets, and the higher rate structure. An earned premium volume of $30 million may be conservatively expected by 1954. Normal earning power on this volume should average about $30.00 per share, with investment income contributing approximately $8.40 per share after deducting all senior charges from investment income. The patient investor in Western Insurance Common can be reasonably assured of a tangible acknowledgement of his enormously strengthened equity position. It is well to bear in mind that the operating companies have expanded premium volume some 550% in the last 12 years. This has required an increase in surplus of 350% and consequently restricted the payment of dividends. Recent dividend increases by Western Casualty should pave the way for more prompt payment on arrearages. Any leveling off of premium volume will permit more liberal dividends, while a continuation of the past rate of increase, which in my opinion is very unlikely, would of course make for much greater earnings. Operating in a stable industry with an excellent record of growth and profitability, I believe Western Insurance Common to be an outstanding vehicle for substantial capital appreciation at its present price of about $40. The stock is traded over the counter. 1,967, National Indemnity Purchase. Referred to in the 2014 letter to shareholders. Berkshire Hathaway Inc. P.O. Box C9, 04, New Bedford, Massachusetts, 02741. The 22nd of February 1967. Jack D. Ringwalt, Omaha, Nebraska. Dear Sir, you have made available to Warren E. Buffett balance sheets of National Indemnity Company and National Fire and Marine Insurance Company dated the 31st of December 1966 and January 31, 1967 respectively, together with an income account. For National Indemnity Company for the year ended the 31st of December 1966. You have further stated that in your opinion these financial statements fairly represent the condition of the companies as of the respective dates and their results of National Indemnity Companies. Operation for the year ended December 31, 1966, and that no major adverse factors, not common to the industry, are known to you at this time. Based upon these representations, Berkshire Hathaway Incorporated will buy shares of National Indemnity Company and National Fire and Marine Insurance Company, and you will sell all shares of these companies you own or control, on the following conditions. On or before Thursday, the 23rd of February 1967, the sum of $8,433,850 in the form of cash or United States Treasury bills will be deposited by Berkshire Hathaway Incorporated with the United States National Bank of Omaha, Nebraska, under the terms of an escrow agreement, copy of which is annexed hereto as Exhibit 1. Thereafter, on February 23, 1967, a tender offer will be mailed to all shareholders of National Indemnity Company and National Fire and Marine Insurance Company in the forms annexed to said escrow agreement as Exhibits A and B. The representations, terms, and conditions of said tender offers are by this reference made a part of this letter. You will accept these offers, which acceptances will cover 83,506 shares of National Indemnity Company and 651 shares of National Fire and Marine Insurance Company. 3. Berkshire Hathaway Incorporated will purchase your shares and all other tendered in accordance with the terms and conditions of said tender offers, provided not less than 80% of the issued and outstanding shares of both companies are tendered for purchase. The present agencies of National Indemnity Company and National Fire and Marine Insurance Company, including those controlled by you, will continue in their present status as long as they continue to be profitable to the insurance companies. You will agree to continue your association with the companies as long as mutually acceptable terms of employment can be made. Yours very truly, Berkshire Hathaway Inc. Warren E. Buffett. Accepted. February 22, 1967. 1975. Pensions. Referred to in the 2013 letter to shareholders. Pensions. There are two aspects of the pension cost problem upon which management can have a significant impact. 1. Maintaining rational control over pension plan promises to employees, and 2. Increasing investment returns on pension plan assets. The irreversible nature of pension promises. To control promises rationally, it is necessary to understand the basic arithmetic and practical rules governing pension plans. The first thing to recognize, with every pension benefit decision, is that you almost certainly are playing for keeps and won't be able to reverse your decision subsequently if it produces subnormal profitability. As a practical matter, it is next to impossible to decrease pension benefits in a large profitable company, or even a large marginal one. The plan may embody language unequivocally declaring the company's right to terminate at any time, and providing that contributions shall be solely at the option of the company. But the law has eroded much of the significance such out clauses were presumed to have, and operating practicalities render any residual rights to terminate moot. So, rule number 1 regarding pension costs has to be to know what you are getting into before signing up. Look before you leap. There probably is more managerial ignorance on pension costs than any other cost item of remotely similar magnitude. And, as will become so expensively clear to citizens in future decades, there has been even greater electorate ignorance of governmental pension costs. Actuarial thinking simply is not intuitive to most minds. The lexicon is arcane, the numbers seem unreal, and making promises never quite triggers the visceral response evoked by writing a check. In no other managerial area can such huge aggregate liabilities which will be reflected in progressively increasing annual costs and cash requirements be created so quickly, and with so little immediate financial pain. Like pressroom labor practices, small errors will compound. Care and caution are in order. Deceptive arithmetic of promise now, pay later. If you promise to pay me $500 per month for life, you have just expended actuarially, but nevertheless, in a totally tangible sense, about $65,000. If you are financially good for such a lifetime promise, you would be better off, if I have an average expectancy regarding longevity for one my age, handing me a check for $50,000. But it wouldn't feel the same. And, if you promise to pay me 1,000 hamburgers a month for life, which, superficially, may sound equivalent to the previous proposition, assuming a present hamburger price of 50 cents, you have created an obligation which, in an inflationary world, becomes most difficulty to evaluate. This creates a risk we talk of later as an earthquake risk. One thing is certain, you won't find an insurance company willing to take the 1,000 hamburgers a month obligation off your hands for $65,000 or even $130,000. While hamburgers equate to 50 cents now, the promise to pay hamburgers in the future does not equate to the promise to pay 50-cent pieces in the future. So, before plans are introduced or amended, the financial consequences, particularly in a world of significant inflation which I believe to be close to a certainty, should be clearly understood by you. Consulting actuaries are very good at making calculations. They are frequently terrible at making the assumptions upon which the calculations are based. In fact, they well may be peculiarly ill-equipped to make the most important assumptions if the world is one of economic discontinuities. They are trained to be conventional. Their self-interest in obtaining and retaining business would be ill-served if they were to become more than mildly unconventional. And being conventional on the crucial assumptions basically means accepting historical experience adjusted by a moderate nudge from current events. This works fine in forecasting such factors as mortality and morbidity, works reasonably well on items such as employee turnover, and can be a disaster in estimating the two most important elements of the pension cost equation, which are fund earnings and salary escalation. My views regarding inflationary possibilities are more extreme than those of most respected observers. It is difficult to substantiate a dogmatic view, since conclusions rest more upon social and political judgments than upon economic training and analysis. You should recognize the subjective nature of the reasoning leading to my pessimistic conclusions regarding inflation over the longer term, and not be reluctant to correct accordingly. Illustrated elemental actuarial principles. To illustrate a few actuarial principles worth understanding, but without employing the technical jargon and the asterisks, let's use the example of your household. Assume that you, personally, make irrevocable promises to pay pensions of $300 per month for life after they reach 65 to, say, 4 household employees. To make it easy, let's say that they each are 55 years of age at present. If you make that promise today, you have reduced your net worth today by about $70,000. For simplicity's sake, I am ignoring some variables such as sex of employees. Women live longer, and therefore cost more death before 65, etc. In calculating such factors, the actuaries shine. Why are you immediately $70,000 poorer? Well, if you set aside a $70,000 fund now and invest it at 7% interest, and let all such interest remain in the fund to be compounded, the principal value of the fund will grow to about $140,000 10 years when your employees reach 65, and to buy them a lifetime annuity of $3,600 per year will then cost about $35,000 each, utilizing the entire accumulated capital of the fund. So, if you make the promise, and it is binding legally or morally, figure you have spent today, $70,000, even though you don't have to pay out a dime of cash for 10 years? Now take it one step further, and assume that your employees each are earning $600 per month, but, instead of promising them $300 per month, upon retirement, you promise them 50% of their salary at the time they retire. If their increases run 2% per year, and they probably will, in the world, I foresee, they will be earning $1,200 per month by the time they reach 65, and it will now cost you $70,000 each to purchase annuities for them to fulfill your promise. The actual cost, today, of modifying your promise from 50% of present pay to 50% of terminal pay was to exactable the fund that needed to be set aside now from $70,000 to $140,000. Many pension plans use final average pay, usually the average of the last 5 years, or the highest consecutive 5 years in the last 10 years employed, and some use career average pay. I am not arguing here which should be used, but am illustrating the dramatic difference in costs that can occur because of rather minor appearing changes in wording. Pension costs in a labor-intensive business clearly can be of major size and an important variable in the cost picture, particularly in a world characterized by high rates of inflation. I emphasize the latter factor to the point of redundancy, because most managements I know, and virtually all elected officials in the case of governmental plans, simply never full grasp the magnitude of liabilities they are incurring by relatively painless current promises. In many cases in the public area, the bill in large part will be handed to the next generation, to be paid by increased taxes or by accelerated use of the printing press. But in a corporation, the bill will have to be paid out of current and future revenues with interest and frequently with what is, in effect, a cost of living escalator. The earthquake risk. In Germany, in the great inflation of the early 1920s, the entire Daimler-Benz, Mercedes automobile company, was selling in the market for the price of 300 motor cars. Almost all past investments were nearly worthless, and current salary levels were astronomical in relation to past history. Under such conditions, or conditions far short of such an extreme, the burden of any pension benefits owed by a business, which are based on current salary levels though related to much earlier service, in employment, must be backed almost exclusively by the current value, earning power of the business. Advance funding simply evaporates. For example, assume that salaries, and the cost of living, are moving upward at 25% per year, and the pension fund is earning 10% per year, a set of assumptions not ridiculously different from what exists in England at the moment. Under such conditions, funds put aside for retirement immediately begin to shrink in relation to promised benefits. Every month fewer hamburgers can be purchased from the funds contributed to the pension plan, even after accumulating dividends and interest on the funds. Almost no one chooses to think about this sort of earthquake risk in dealing with pension plans, any more than people choose to spend much time thinking about nuclear war. It may be my earlier mentioned bias, or me mathematical bent, but I believe some unthinkable inflation-related calculations should be made and even considered before any company assumes open-ended pension obligations guaranteeing a large number of persons absolute protection against inflation by gearing benefits without limit to final pay, or escalating benefits to persons already retired, based on changes in the cost of living. Thus, the really devastating possibility regarding private pension plans is sustained double-digit inflation. When salaries move ahead at a substantially higher rate than investment returns, and benefits are tied to final salaries, or, even more expensively, cost of living increases after retirement as in recent rubber and aluminum contracts, it is virtually impossible to pre-fund obligations. Like it or not, you become much like the Social Security Fund, absent the power to tax. Should that occur, future purchasers of the products of the company must be willing to do so at prices that reflect not only the wages of current workers, but the promises to past workers. Some businesses will have economic characteristics allowing them to pass along these costs, but others will have major troubles. On balance, I believe we are in relatively favorable businesses under such circumstances. I do not believe this problem can be solved by the investment process. I mention it for completeness, not because I have answers, and to urge caution in making pension benefit promises subject to dramatic escalation through substantial attrition in the purchasing power of Money. Now let's look at funding and investment behavior appropriate to an economic world at least reasonably similar to the past. Recognizing that such a world is far from a certainty. The investment management problem inherent in all pension plans. Once having committed to provide pensions, how do we pay? The law and prudent business practice mandate that we start putting aside funds on a fairly orderly and consistent basis from which we can fulfill our promises. In this manner, we pay the employee currently while he is being productive for the company, and we simultaneously set up a savings account, collectively, not individually, which will accumulate interest, so as to purchase an annuity, not actually purchased in most plans, of course, just assured by the pension fund, FOP him at retirement, which will discharge our promise to pay him throughout his non-productive years. Thus, our current cost and current cash requirements, if our estimates are accurate as to what we will earn on the savings account, as well as other estimates regarding turnover, salary escalation, longevity, etc., will reflect his total lifetime employment costs to us spread rather evenly over his productive years. This advance funding treatment, matching full current costs against current production, contrasts with the Social Security Plan's program, which essentially taxes current producers to pay current non-producers. This simply means moving a portion of current national output of goods and services over from those who produced it to those who are non-producing and to whom promises have been made. If such a system had been in effect for a very long time, the demographic profile remained fairly constant, the promises remained fairly constant, and there was no inflation, the net effect from such a pay-as-you-go approach would not substantially differ from an advance funding basis. However, these conditions do not exist, which may make for various problems, including some that exacerbate inflation and thus have negative fallout for the economics of private plans. Because a business corporation, unlike the federal government, has to create a savings account, an investment accumulating and investment management operation of some sort to properly fund its pension plan, it must make investment management decisions with respect to pension plan assets. The history of Corporate Pension Plan Management Act won the awakening. A few decades ago, pensions were a relatively new thing at most companies, so that the savings accounts were in their formative stages and they're much smaller. Furthermore, promises were fractions of those presently made, so that the amount eventually required in the savings account to purchase the required annuity at retirement was correspondingly smaller. Thus, the amounts paid into pension funds, savings accounts, were largely forgotten so far as managerial responsibility was concerned until the Great Awakening of the 1960 seconds. At that time, managements noticed 1. The funds had grown to the point where they sometimes were 25% to 50% of the net worth of the company, often making the assets employed in the savings account larger than those employed in the company's largest division. Here are a few figures which I have handy from year-end 1972, in millions. So, while U.S. Steel had a visible $3.6 billion in net operating assets which management probably spent 99% plus of their business hours thinking about, they had $2.2 billion in the bank, whose economic results would impact future values for the shareholders, dollar for dollar, with the economic results of the steel assets. There literally were years when the savings account earned more than was earned out of all operating assets of the steel business. In fairness to U.S. Steel, it should be mentioned that they were one of the pioneers in recognizing the importance of pension assets and have done a better than average job through in-house management. 2. The returns actually realized on the savings account had an enormous impact on costs. A sustained 1% change in earning rate could easily swing the annual cost to the contributing company by 15%. 3. During a period when equities had produced fabulous returns, many of the plans had been invested largely in bonds, which not only bore low fixed rates of 3% to 5% in the earlier periods, but also had suffered significant shrinkages in market values as interest rates increased secularly. If interest rates go up, bond prices must go down, and if the bonds are long-term and the rates rise sharply, prices go into a power dive. 4. Many managements thus saw their largest division earning dismal rates of return with substantial market value shrinkage in the bond component, while all around them high returns were being realized from stocks with little apparent effort or talent. If a company had $100 million invested in its engine division earning 12% by managerial zeal and ingenuity, why tolerate $100 million in its pension fund division poking along at only 4% because of inattention, particularly when increasing the $4 million to some larger figure would have the same impact in future earnings for owners as raising margins on engines. Intensive effort on production, research and sales might only produce an increase from 12% to 13% in the engine area, since decisions already had been so near to optimal, but it weighs easy to imagine 4% becoming 10% in the pension fund area if just average results were attained in equity investment. And of course, who would settle for being just average? The History of Corporate Pension Plan Management Act. 2. The Great Leap. And so the hunt was on. Wall Street abhors a commercial vacuum. If the will to believe stirs within the customer, the merchandise will be supplied without warranty. When franchise companies are wanted by investors, franchise companies will be found and recommended by the underwriters. If there are none to be found, they will be created. Similarly, if above-average investment performance is sought, it will be promised in abundance, and at least the illusion will be produced. Initially, those who know better will resist promising the impossible. As the clientele first begins to drain away, advisors will argue the unsoundness of the new trend and the strengths of the old methods. But when the trickle gives signs of turning into a flood, business Darwinism will prevail, and most organizations will adapt. This is what happened in the money management field. The banks had traditionally been the major money managers, leaving aside insured plans, and, by and large, their investing as well as their communication had been lackluster. They felt obliged to seek improvement, or at least the appearance of improvement, as corporate managers searched for yardsticks by which to make their decisions as to whom care of this newly discovered giant division should be granted. The corporate managers naturally looked for groups with impressive organizational charts, lots of young talent, hungry but appropriately conscious of responsibility, heavy on MBAs from good schools, a capacity for speed in decision-making and action, in short, organizations that looked something like they perceived themselves. And they looked for a record of recent performance. Unfortunately, they found both. A little thought, of course, would convince anyone that the composite area of professionally managed money can't perform above average. It simply is too large a portion of the entire investment universe. Estimates are that now about 70% of stock market trading is accounted for by professionally managed money. Any thought that 70% of the environment is going to substantially outperform the total environment is analogous to the fellow sitting down with his friends at the poker table and announcing, "Well, fellows, if we all play carefully tonight, we all should be able to win a little." Way. An interesting example of this line of thinking, subspecies wishful, occurs in the April 1975 Conference Board Trends in Pension Fund Administration article which Marty sent me the other day. In a careful written investment guideline statement by a manufacturing company, IDIS announced, "We believe it is reasonable to expect long-term results superior to the usual market indexes, the S&P 500 inches particular. Specifically, we look for performance better than this index in all types of market environments." And yes, Virginia, maybe every football team can have a winning season this year. So, clearly the almost universal expectations of above-average performance in pension fund management were doomed to disappointment. These disappointments were certain to be amplified by a corollary affliction that frequently accompanies pressure for investment performance: higher turnover rates. It is difficult to measure turnover costs with precision, but they certainly must run at least 2% on average when applied to the round trip of purchase and sale. If an investment manager, striving for not only acceptable quarterly performance but also for the appearance of behaving as other highly thought of managers are known to be behaving, moves aggressively to keep his portfolio in the right stocks, he easily can average turnover rates of 25% per year. When the performance rage peaked, drastically higher turnover figures were recorded with some managers. In the short term, it frequently is better to look smart than to be smart, particularly if your employment is to be decided by a rather brief interview. If the fans are going to decide your hiring status based on only a few swings, it is prudent to develop a batting style that will remind them of Joe DiMaggio or Ted Williams, even if long-range your percentage of solid hits with that style is small, and you obtain better results batting cross-handed. In any event, a 25% turnover rate among professionals as a group, with 2% costs attached to such turnover, reduces group performance by 0.5% per annum. $1 billion per year on $300 billion of assets. This means that, instead of chance dispersal of results causing half of all managers to fall above the unmanaged performance level, which has no transaction costs, and half to be below, the frictional drag of turnover costs causes well over half to perform worse than what average might be assumed to be. For the reasons set forth above, almost all recent investment management performance by pension funds of large corporations has been fair to poor. Specifically, the Berkshire study, most comprehensive of all pension investment measuring services, reports the following. Overall annual return, excludes bond segment of portfolios, so that equity management only is measured against the equity yardstick. Is there hope? Can a wise corporation assure superior investment performance for its pension plan? If above-average performance is to be their yardstick, the vast majority of investment managers must fail. Will a few succeed due either to chance or skill? Of course. For some intermediate period of years, a few are bound to look better than average due to chance, just as would be the case if 1,000 coin managers engaged in a coin flipping contest. There would be some winners over a 5 or 10 flip measurement cycle. After 5 flips, you would expect to have 31 with uniformly successful records who, with their oracular abilities confirmed in the crucible of the marketplace, would author pedantic essays on subjects such as pensions. In addition to the ones benefiting from short-term luck, I believe it possible that a few will succeed in a modest way because of skill. I do not believe they can be identified solely by a study of their past record. They may be operating with a coin that they know favors heads, and be calling heads each time, but their bare statistical record will not be distinguishable from the larger group who have been calling flips indiscriminately and have been lucky so far. It may be possible, if you know a good deal about investments as well as human personality, to talk with a manager who has a decent record and find that he is using methods which really give an advantage over other investors, and which appear to be likely to provide continued superiority in the future. This requires a very wise and informed client, and even then is not free from pitfalls. For openers, there is one huge, obvious pitfall. I am virtually certain that above-average performance cannot be maintained with large sums of managed money. It is nice to think that $20 billion managed under one roof will produce financial resources which can hire some of the world's most effective investment talent. After all, doesn't the big money at Las Vegas attract the most effective entertainers to its stages? Surely $50 million annually of fees on $20 billion of managed assets will allow A, an array of industry specialists covering minute-by-minute developments affecting companies within their purview, B, top-flight economists to study the movement of the tides, and C, nimble, decisive portfolio managers to translate this wealth of information into appropriate market action. It just doesn't work that way. Down the street there is another $20 billion getting the same input. Each such organization has its own group of bridge experts cooperating on identical hands, and they all have read the same book and consulted the same computers. Furthermore, you just move $20 billion or any significant fraction around easily or inexpensively, particularly not when all eyes tend to be focused on the same current investment problems and opportunities. An increase in funds managed dramatically reduces the number of investment opportunities, since only companies of very large size can be of any real use in filling portfolios. More money means fewer choices, and the restriction of those choices to exactly the same bill of fare offered to others with ravenous financial appetites. In short, the rational expectation of assuring above-average pension fund management is very close to nil. Illustrations of reality in pension fund investment management. I recently received some interesting figures from a pension fund involving about $250 million of assets. The 9-to-1 2-year record through June 30, 1975 of the 3 major banks involved, managing $50 million per bank, follows, compared to average as defined in 2 ways, the S&P 500 and the DJ, Industrials, S&P 500. First National City plus 1%? Until recently, Chase had managed a comparable segment of the funds but was terminated because of poor performance, probably worse than the other banks shown above. Each percentage point plus or minus affected this fund by about $2 to $4 million over the time period measured. A further interesting calculation was made. On June 30, of the portfolio held by Continental, 64% of the securities held, measured by market value, also were in the Morgan portfolio, and 44% were duplicated in the First National City portfolio. Similar overlap was demonstrated in other ways. I am familiar enough with the record of this fund to state that no unusual constraints have been placed on the managers, and no special factors have to be recognized to interpret the numbers. I believe that Morgan's above-average record here, compared to that of other large banks, is typical of its relative performance at other pension funds. I also feel the predictive value of that relative standing to be low. Pensions and Investments magazine recently rated the 35 largest banks for which 5-year performance records of commingled equity funds were available. 10 did as well as or better than the S&P, consistent with what might be expected according to probability theory. If everyone were operating solely according to chance, and there was a modest drag on performance caused by transaction costs. More importantly, I know of no set of statistics which would demonstrate any opposite view relating to managers handling large amounts of money. The evidence all seems to confirm that it is unwise to expect above-average investment results from a corporate pension plan, conventionally managed. Major options in pension fund management. With respect to pension fund investments in securities, several paths can be followed, singly or in combination. 1. One or more large conventional money managers may be retained, with the expectation that performance will be slightly poorer than average because of costs involved. If the manager is very large and conventional, any major bank will do. Directors of the corporation should run no risk of imprudent behavior as fiduciaries under the new ERISA statute. Conventional behavior is safe, even when the potential litigants have the benefit of hindsight. If we should go this route, I see no reason to change from Morgan. 2. Management and security selection can be, in essence, abandoned by simply creating a portfolio which is equivalent to average. This minimizes turnover and management costs, and probably accomplishes about the same result as 1. Perhaps with just a touch more potential liability for results, since a tacit admission has been made that no effort is being expended to manage. Several funds have been established fairly recently to duplicate the averages, quite explicitly embodying the principle that no management is cheaper, and slightly better than average paid management after transaction costs. This policy could be implemented by participating in such funds, or on a do-it-yourself basis. 3. A manager can be found handling smaller amounts, whose record has been good for the right reasons. Then hope that no one else finds him. Good records of any type usually have attracted massive money flows, whether the record was based on unusual skill, luck, or even, occasionally, semi-fraudulent activity which has manufactured record. Even those records which I believe to have been based at least partially on skill have wilted when subjected to torrents of money. A further problem is that in no case were the superior records I have observed based upon institutional skills, which could be maintained despite changes in the faces. Rather, the good results have been accomplished by a single individual, or, at most, a few, working in fairly specialized areas in which the great bulk of investment money simply had no interest. It has been very difficult to outthink the pack on General Motors, IBM, Sears, etc. Rather, the unusual records, and there have been few that have been maintained, have been achieved by those who have worked relatively neglected fields in which competition was light. Section. Your win-loss percentage in tennis will not be determined by the absolute level of ability that you possess. Rather, it will be determined by your ability to select inferior opponents. If you select with care, it will be quite easy to attain a winning percentage higher than, say, Cliff Rishi while he is playing on the tour. Application of this principle is the key element in bridge, poker, or investments. Harder to apply in the latter, however, it is easier to identify a couple of palookas at the bridge table. Many pension funds, including the fund to which I referred earlier, have attempted to find superior but relatively unknown managers, still working with small sums. This often involves dozens of interviews, and usually comes down to the past record, particularly the recent past, plus an articulate practitioner who looks reasonable and respectable. In my opinion, based only on impressions, the overall record from this selection process has been poor, and very likely worse than the mildly below-average record of the major money manager. The reason isn't too hard to see, particularly with a rear-view mirror. Much of Wall Street is a succession of fashions. Obviously, some individuals will have hit the most recent fashion, and their record will look correspondingly good, maybe sensationally good if they have a reckless streak, and have played a particular trend very hard. But fashion hitting never has been successfully maintained, to my knowledge. And the manager primarily selected for recent hot performance knows what he is expected to do. He is to perform and quickly. So the new small manager's decisions frequently are characterized by high turnover, major mistakes, even more furious activity to catch up, etc. It has not happened every time, but my hunch is that the sum total performance of the relatively unknown go-go managers for pension funds has been worse than the lumbering, stiff-legged minuet performed by the major banks. 4. A fixed income, bonds, investment strategy can be followed, which presently allows returns of about 9% per annum that can be locked in for some time. This option currently is becoming somewhat more popular, should be quite defensible under ERISA, and will look good or bad, depending upon what returns from equity holdings develop over the next decade or two. This essentially is the same decision that was made by default several decades ago by many companies, except the rates then were 4% instead of 9%. I do not recommend an attempt by us to go back and forth from bonds to stocks. This is a skill possessed by few, if any, and certainly not by a group. If we could master this particular form of alchemy, there would be little reason to do anything else. The comfort level produced by this option is likely to be high under any conditions, except high rates of inflation, which will produce distress under all of the options discussed herein. 5. My final option, and the one to which I lean, although not at anything like a 45-degree angle, is mildly unconventional, thereby causing somewhat more legal risk for directors. Asterisk. It may differ from other common stock programs, more in attitude than in appearance or even results. It involves treating portfolio management decisions much like business acquisition decisions by corporate managers. Asterisk. I am leaving most of the legal discussion out of this memo, partly due to space considerations, and partly because it is not my field. In general, the safest course is to behave as most others are behaving, and to trust in the expertise of large, well-regarded conventional organizations. I also believe it is defensible, although not as automatically defensible, to diversify among a group of well-financed entrenched businesses purchased at reasonable valuations of earnings and assets. The directors and officers of the company consider themselves to be quite capable of making business decisions, including decisions regarding the long-term attractiveness of specific business operations purchased at specific prices. We have made decisions to purchase several television businesses, a newspaper business, etc. And in other relationships we have made such judgments covering a much wider spectrum of business operations. Negotiated prices for such purchases of entire businesses often err dramatically higher than stock market valuations attributable to well-managed similar operations. Longer term, rewards to owners in both cases will flow from such investments proportional to the economic results of the business. By buying small pieces of businesses through the stock market rather than entire businesses through negotiation, several disadvantages occur. A. The right to manage or select managers is forfeited. B. The right to determine dividend policy or direct the areas of internal reinvestment is absent. C. Ability to borrow long-term against the business assets versus against the stock position is greatly reduced. And D. The opportunity to sell the business on a full value, private owner basis is forfeited. These are important negative factors, but if a group of investments are carefully chosen at a bargain price, it can minimize the impact of a single bad experience in, say, the management area, which cannot be corrected. And occasionally there is an offsetting advantage which can be of very substantial value, but for which nothing should be paid at the time of purchase. That relates to the periodic tendency of stock markets to experience excesses which cause businesses, when changing hands in small pieces through stock transactions, to sell at prices significantly above privately determined negotiated values. At such times, holdings may be liquidated at better prices than if the whole business were owned, and, due to the impersonal nature of securities markets, no moral stigma need be attached to dealing with such unwitting buyers. Stock market prices may bounce wildly and irrationally, but, if decisions regarding internal rates of return of the business are reasonably correct, and a small portion of the business is bought at a fraction of its private owner value, a good return for the fund should be assured over the time span against which pension fund results should be measured. It might be asked what the difference is between this approach and simply picking stocks a la Morgan, Scudder, Stevens, etc. It is, in large part, a matter of attitude, whereby the results of the business become the standard against which measurements are made, rather than quarterly stock prices. It embodies a long time span for judgment confirmation, just as does an investment by a corporation in a major new division, plant, or product. It treats stock ownership as business ownership, with the corresponding adjustment in mental set. and it demands an excess of value over price paid, not merely a favorable short-term earnings or stock market outlook. General stock market considerations simply don't enter into the purchase decision. Finally, it rests on a belief, which both seems logical and which has been borne out historically in securities markets, that intrinsic business value is the eventual prime determinant of stock prices. In the words of my former boss, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Specifically, it probably is possible to invest the $12 million in our pension fund in a dozen businesses, maybe more. ERISA emphasizes diversification with current intrinsic value, measured by private owner valuations and transactions attributable to our investment of, say, $20 million, and current earnings of at least $1.5 million. The portion of such earnings paid out to us clearly is worth 100 cents on the dollar, and a reasonable batting average by the managements of companies in which we invest should result in the portion reinvested having similar value. If this is the case, such a pension division operation will produce better returns than bond investment at current rates. The main long-term risk would be that future returns on capital obtained by division managers would turn sour. In some individual case that undoubtedly would prove true. It might well be that there also would be a favorable surprise or two. That is true of any acquisition program. The one substantial advantage that this division would have would be attractive purchase prices far below those available for purchasers of entire businesses. If purchases could not be made on such a bargain basis, we simply would wait until they could. A second advantage would be the flexibility provided by a public stock market, allowing portions of business operations to be acquired or divested much more easily than entire operating businesses. It must be emphasized that measurement of this program would have to be based on the progress in our share of earnings and assets of the constituent companies, not short-term market movements. We would expect substantial increases in earnings, dividends, and asset values over, say, a decade, just as we expect with our operating divisions at Washington Post. We would, in mental approach, have created a new diversified division, currently capitalized at about $12 million, which is expected to earn a better than bond rate with which to eventually pay retired employees. In a sense, this is what was done in the profit-sharing fund when it accumulated Washington Post stock throughout earlier years. Basically a wise decision because the business earned very well internally and thereby grew in value at a substantial rate. It was an attractive partially owned business, acquired at an attractive price. Until market prices were introduced, which complicated things, the funds built up through this self-owning division were significantly larger than would have been achieved by buying bonds or the general run of common stocks. If it should be decided to implement such a policy, recommendations should be obtained from qualified analysts who clearly understand our rather usual selection criteria. This could be handled on a quite infrequent basis. As mentioned earlier, a policy also could be followed, combining more than one option. Most combinations have been 1 and 3 or 1 and 4, but 4 and 5 could well be more logical. Pension asset management in the scale of business priorities. Of course, the desirability of even considering something non-conventional, not to be equated with more risk, the exclusive benefit provision of ERISA requires fiduciaries to discharge their duties solely in the interests of the participants and beneficiaries, relates to the relative impact pension results can have on overall earnings. One of my friends always reminds me, if a thing's not worth doing at all, it's not worth doing well. If our pension assets were $1 million and likely to grow only a few $100,000 a year, it would be ridiculous to think of any activity that might incur even unwarranted criticism, let alone litigation. On the other hand, if we had U.S. Steel's pension situation, we might want to make a truly top priority project out of pension asset management as they have, even if we might slightly increase personal risks to directors by so doing. We fall in between, although, if you look through to the plans to which we contribute but don't manage, guild, mechanical, etc., we are moving more in the direction of U.S. Steel. It is likely that within 10 years we will have $40 million in our direct pension division, and further substantial sums in other plans presently on an indirect basis. Earnings of business cease purchase through this division should run at least $5 million per year. In prior years it was felt that by limiting contributions to union plans to so much per shift, or per hour, management was relieved of responsibility for any specific level of benefits, as well as pension fund administration. The shield of this hands-off position is eroding, and we should recognize that we may well have responsibility at some future date for benefits promised under these plans, which we originally thought involved only defined contributions. With this in prospect, we may wish to gain at least partial command over fund investments in this area. Summing up, 1. If the economic world turns out to be one of sustained double-digit inflation, probably still unlikely but not unthinkable among the carnage will be private pension plans. The investment process can do little to modify that disaster. Hope lies mainly in the care with which past promises have been made, and the ownership of a business whose economic characteristics allow pass-through pricing, which includes a large part of past labor costs, as well as full current costs. 2. In a more orderly world, the care with which promises have been worded remains important, but on a scale that diminishes as inflation moderates. Conventional approaches to money management should not be expected to produce above-average results, but average will be perfect acceptable at low inflation rates. 3. A mildly non-conventional investment approach, emphasizing a business approach to security selection, gives some opportunity for long-term results slightly above average without corresponding increase in investment risk. Warren E. Buffett, 1978, Diversified Retailing Merger. Letter of the 27th of November, 1978, which accompanied a prospectus related to the 1978 merger of Diversified Retailing Company into Berkshire. Warren E. Buffett, 1440 Kiewit Plaza, Omaha, Nebraska 68131. The 27th of November, 1978, to the stockholders of Berkshire Hathaway Inc. and Diversified Retailing Company, Inc. C. This formidable document describes the business activities of Diversified and Berkshire, as well as the reasons why the boards of directors of those companies favor the merger of Diversified into Berkshire. I urge you to read this material carefully. It not only will aid you in voting intelligently on the merger, but probably will enhance your understanding of your investment in Berkshire or Diversified. Berkshire shareholders will find that the size of the proposed merger is not proportional to the size of this document. Because Diversified owns a large interest in Berkshire, there will be an effective net increase of no more than 500 inches the outstanding shares of Berkshire, should the merger be approved, an increase of less than 6% from the amount presently outstanding. Berkshire will acquire several important assets, the most significant being 841,900 shares of blue-chip stamps. This 16% interest, added to Berkshire's present holdings, will give Berkshire majority ownership of this large profitable company. However, should the merger be approved, Berkshire will assume about $15 million of Diversified debt, and these liabilities must be weighed against the value of the assets acquired. My personal belief is that both Diversified and Berkshire shareholders will benefit from the merger. But I will vote for the merger only if a majority of the shares which are voted by other shareholders of each company are voted to approve it. Experience indicates that earnings forecasts frequently are very wrong. For what it is worth, my own estimates indicate that the merger would produce some improvement in per-share operating earnings for Berkshire stockholders. Diversified's 60 stockholders presently own a non-marketable security, a condition the merger would cure. Although not quantifiable, I believe a further important benefit to be the simplification of ownership and management structures of Diversified and Berkshire. Tax and regulatory complications, as well as investor perplexity, are created by our existing structure, and your management is eager for the reduction in planning and operational problems which a Diversified Berkshire merger would achieve. A much more complete discussion is contained in the following pages. Sincerely, S. Warren E. Buffett. 1980, Illinois National Bank spin-off letter. Letter of the 26th of November 1980, which accompanied an exchange offer pursuant to which Berkshire accomplished the required divestiture of its interest in the Illinois National Bank and Trust Co. of Rockford. Berkshire Hathaway Inc. 1440 Kiewit Plaza, Omaha, Nebraska 68131. Warren E. Buffett, Chairman. The 26th of November, 1980. To the shareholders of Berkshire Hathaway Incorporated. The succeeding document describes an exchange offer involving stock of Rockford Bancorp Incorporated, which holds the 97.7% of the Illinois National Bank and Trust Co. of Rockford, formerly held by Berkshire Hathaway, and stock of Berkshire Hathaway. As you know, by statute Berkshire is required to dispose of the bank before year-end. The exchange plan which we adopted is relatively complex, and I urge you to read carefully the prospectus in its entirety so that you can make a fully informed decision as to how to respond to the offer. The purpose of this letter is to offer to you my views with respect to Berkshire, Bancorp, and the exchange offer. You can give as little or as much weight to these views as you choose. We could have simply spun off the shares of Bancorp to our shareholders in a pro rata basis. The exchange plan adopted gives you all the advantages of such a pro rata spin-off since, if you so desire, you can be guaranteed a pro rata participation in both Bancorp and Berkshire. If you make this election, you will own exactly what you now own, but you will have stock certificates in two companies rather than one. However, under the exchange plan, shareholders who prefer the prospects of one company over those of the other will have the opportunity to enhance their position in their favored company by decreasing their relative interest in their less favored company. In my opinion, this is a valuable option. It would not have been available without considerable tax cost to our shareholders if we had opted for a normal spin-off plan. Setting the exchange ratio, of course, was the tough part. Basically, it was me responsibility. Much more per share reported tangible book value and historical reported earnings come with the Bancorp stock. However, that Bancorp tangible book value would be reduced significantly, about 27% at September 30, 1980, if bonds of the bank carried at amortized cost were instead carried at market value. The bank is a very good business, one of the best earning banks in the country. But, because of the industry and the state in which it operates, its growth prospects are limited, and federal bank holding company statutes severely restrict the business flexibility of Bancorp. See pages 26 to 28 of the prospectus. In my opinion, Berkshire is a better business with more strategic alternatives from which to choose. Berkshire holds sizable equity interests in businesses with significant earning power, which is not reflected in its reported earnings. See pages 4 and 40 of the prospectus. In evaluating Berkshire, however, I cannot ignore that non-reported earning power. So, that's pretty much the choice as it appears to me. Bancorp with much better numbers and good prospects, and Berkshire with good numbers and much better prospects. If you have a hard time making up your mind, I will consider my job well done. You will notice that under the plan you can decide to increase, maintain, or reduce your proportional interest in each company. But, if you go up proportionately in one, of course you go down in the other. The only shareholder who doesn't have this option is me. If Berkshire holders collectively decide that I have made Bancorp the more attractive security, their exchange elections will cause my proportional interest in Bancorp to decrease, and my interest in Berkshire to increase. If they decide the reverse, I will end up with a large interest in Bancorp, and an interest in Berkshire that is less than my current approximately 44% interest. This technique embodies the world's oldest and most elementary system of fairly dividing an object. Just as when you were a child and one person cut the cake, and the other got first choice, I have tried to cut the company fairly, but you get first choice as to which piece you want. Of course, one thing I can promise is that 10 years from now, one of the pieces is likely to look a whole lot larger than the other. That's the nature of uncertain business world. Most of our acquisitions look either better or worse than originally projected within a couple of years after purchase. But viewed prospectively, a share of Bancorp and a share of Berkshire now look like equivalent pieces of cake to me, one with more flour, the other with more frosting. I have one hope on this exchange offer, and that is that most of you either decide to participate on more than a pro rata basis in Bancorp, or, alternatively, decide to stay entirely with Berkshire. Bancorp's corporate life will be simplified if it has a relatively small number of shareholders, most of whom have a significant investment, rather than a large number of holders who have elected pro rata participation, and then hold relatively inconsequential amounts of Bancorp compared to their Berkshire holdings. But the choice is up to you. Both should be decent investments. Sincerely, Berkshire Hathaway Incorporated. By Warren E. Buffett, Chairman of the Board and Chief Executive Officer. 1983. Nebraska Furniture Mart Purchase Letter. Referred to in the 2013 letter to shareholders. Berkshire Hathaway, Inc., 1440 Kiewit Plaza, Omaha, Neb. 68131. The 30th of August, 1983. Mrs. Rose Blumkin, and family, Omaha, Nebraska. 1. You own 100% of the outstanding stock of Nebraska Furniture Mart, Incorporated, NFM. which operates a remarkably successful furniture and appliance retailing business from a single large warehousing and selling location, approximately 43 acres, including surrounding land held for expansion in West Omaha. 2. Berkshire Hathaway Incorporated. Berkshire has long admired what you have accomplished together, and hereby proposes to purchase from you 90% of such outstanding stock for $55,350,000 cash. All of the 10% outstanding stock not sold to Berkshire will be retained by Mr. Louis Blumkin and his sons, and Berkshire, concurrently with its purchase of NFM stock, will make arrangements with Louis Blumkin and his sons as specified in Exhibit A, attached hereto. 3. The closing will occur immediately after satisfaction of the legal requirements of the Hart-Scott-Rodino amendments to U.S. antitrust law, which Berkshire, with your cooperation, will accomplish as rapidly as possible. This will no doubt be a mere formality, about 100% sure to occur within 50 days after you accept Berkshire's proposal, because Berkshire has no interest in any other furniture or appliance business, and consequently, Berkshire's purchase of NFM stock will cause no increase in any one entity's share of the furniture or appliance business in any market. If the Hart-Scott-Rodino delay turns out to exceed 50 days, the purchase price for NFM stock will increase at the rate of 12% per annum during any delay period in excess of 50 days, but exceeding 90 days after acceptance. In the event Hart-Scott-Rodino delay exceeds 90 days, which Berkshire considers inconceivable, either side may at its option terminate all obligations to close the transaction. 4. At the closing, each of the stockholders of NFM will warrant that good title to such stockholders' stock is transferred to Berkshire, and Louis Blumkin will certify to Berkshire that, to the best of his knowledge and belief, a. Berkshire is acquiring 90% of the outstanding stock of NFM, and NFM has no obligation, contingent or otherwise, to issue additional shares, and b. that the income tax return, together with incorporated accounting data, of NFM and its wholly owned subsidiary which owns part of the approximately 43 acres, partially vacant, on which NFM conducts warehousing and retailing operations for the fiscal year ended the 31st of January 2082, a copy of which has been furnished Berkshire, fairly represents the consolidated operations of NFM during such fiscal year, and its balance sheet condition at the end thereof, and c. Since the 31st of January 2082, a. business operations of NFM have not been less successful than in the fiscal year ended the 31st of January 2082, b. all transactions, except for the purchase of the 2 real estate parcels described below, of NFM have been in the ordinary course of conducting and expanding its business. c. balance sheet condition of NFM has improved roughly as disclosed in its unaudited balance sheet of the 31st of July 2083, a copy of which has been furnished to Berkshire. And d. no dividends have been declared or paid by NFM between the 31st of July 2083 and the closing date. 5. Immediately after the closing, Berkshire will cause NFM to offer to sell for cash, at present value, agreed to be $1 million, to former NFM stockholders, pro rata or as such former NFM stockholders may otherwise specify, 2 parcels of real estate in Omaha which changed plans by NFM make unnecessary for anticipated operations. 6. If the foregoing meets your approval, kindly return counterparts of this letter signed by or on behalf of all stockholders of NFM, which will constitute this letter a contract between SUC, stockholders, and Berkshire. Yours very truly, Berkshire Hathaway, Inc. Warren E. Buffett, Chairman. Accepted. 2001. To 9/11, letter to managers. Shortly after the September 11th terrorist attack, Berkshire's chairman, Warren E. Buffett, sent a letter to the CEO of each of Berkshire's operating businesses. The letter is reproduced below. Memo. 2. Berkshire Hathaway Managers. The All-Stars. From Warren E. Buffett. Date: the 26th of September 2001. The last few weeks have been tough times for all of us in our personal lives, and for many of us in our business activities. At Berkshire, we have estimated our September 11 insurance loss was $2 billion. We've labeled this a guess because that's all it is. It will be many years before we can tell the world within a narrow range what the true figure was. A very high percentage of the loss occurred in our U.S. insurance companies, with the balance in German and UK entities, because we have regularly paid very large amounts of U.S. income taxes. We will bear 65% of the cost applicable to the U.S. operations. The government will bear 35%. Many insurers will not have their loss mitigated in this manner, and some may not survive. Though much of our loss will be paid very soon, significant payments in the liability area will take a considerable time to settle. Even with tax recoveries, our loss is huge. Nevertheless, it's one Berkshire can easily bear. We have long been in the supercat business, and we have been prepared, both financially and psychologically, to handle them when they occur. This won't be our last hit, though we fervently hope disasters in the future arise from natural causes, rather than be man-made. We also would hope they would be of lesser magnitude. What should you be doing in running your business? Just what you always do. Widen the moat, build enduring competitive advantage, delight your customers, and relentlessly fight costs. With the exception of insurance pricing and coverages, almost all operating decisions that made sense a month ago make sense today. For my part, I'll keep looking for sensible acquisitions and continue to manage our resources so that Berkshire remains a financial rock of Gibraltar. I'm sure we are in a recession, probably a relatively deep and extended one, but they are part of business life and we are prepared. In short, you do the managing and I'll do the worrying. That's a division of labor that's worked for us in the past, and it will continue to work well in the future. Thanks, as always, for the great job all of you do that, in turn, makes my job so easy. Warren. P.S. If you wish, share this message with any of your associates.